It
So
would
we
be.
have the money supply
When
shrink. Yeah.
I say catastrophic, I mean catastrophic. You would have a world depression.
Steve Hanke, professor of applied economics at Johns Hopkins University, returns to dissect and analyze last week's huge jobs numbers: 254,000 jobs added, much greater than the consensus expectation of only 140,000 jobs. What does this mean, though? What's under the surface? We'll get his take, but let's take a listen to what Larry Kudlow and Donald Trump had to say about this.
I want to begin. Today's jobs numbers come out, and the top line was very solid jobs report. Americans are working. But, you look under the hood. It's the same stuff. I just want to read a couple of things. Full-time jobs down almost 500,000. Part-time jobs up 800,000. Manufacturing jobs down again. 825,000 native-born jobs lost. 1.2 million foreign-born jobs gained. These are uncomfortable statistics. There's something wrong. There's something unbalanced about all these numbers and where the country's going.
We'll also be going over oil markets and what could potentially cause a global depression, according to Professor Hanke, and China's recent stimulus measures. So, Professor, welcome back. Now, what do you think of Kudlow's remarks? And specifically, before we play Trump's response, is Kudlow right? Do these numbers seem fishy or odd to you?
I agree with Kudlow. I think if you look under the hood, it's fairly clear that things are deteriorating. The top line number looks great, but I don't pay too much attention to it anymore because my first reaction was, of course, the top line number, it looks good. We're coming into an election, and the establishment wants to stay in the establishment. Remember, we had a big revision and these things down by over 800,000 several weeks ago. Now, all of a sudden, we get a surprise bump up. And my guess is this top line number will end up being revised down.
Well, let's take a look at how it's being reported. So here we have a CNN article here. Employers added an estimated 254,000 jobs in September, according to data released by the BLS. All right. Importantly, this is up a lot from the expected number, which is 140,000 jobs. The unemployment rate also fell, dropped from 4.2% to 4.1%. The consensus was 4.2%, so no change. So that beat expectations. Robust service growth hiring, particularly across the healthcare sector, plus 71,000 jobs. Leisure and hospitality, plus 78,000 jobs, drove last month's job gains. Service industries accounted for 202,000 of the monthly gains. So hiring was more muted across goods-producing industries. What do you think the government, particularly the Fed, is thinking? Because you and I can sit here and discuss what's under the hood all day long, but importantly, the market would like to know how it's being interpreted by the FOMC. Do you think they look under the hood?
Not so much, though. I think their conclusion was that, at least if you believe what Powell is. If you believe Powell believes what he's saying, his interpretation was the job market's pretty robust, and the Fed does look at the job market. That's a very important thing. So if they think it's robust, maybe they won't go for a 50 basis point rate cut the next meeting in November. Maybe they'll go for 25.
Do you think they'll pause rate cuts altogether?
My interpretation is these numbers are not going to shove them to making unexpectedly large cuts in the federal funds rate or stopping, more importantly, quantitative tightening, which no one even talks about that. But quantitative tightening, shrinking the balance sheet of the Fed's balance sheet is still in place, still in gear. And by the way, that's why the rate, I said the money supply is lower now, the stock of money, than it was in July of 2022. But the rate of increase year over year in the money supply is still below Hanke's golden growth rate of 6% per year, which is a rate of growth in the money supply consistent with hitting the inflation target of 2%. So it's tight. Any way you cut it, it's tight. And the Fed should have dropped quantitative tightening a long time ago, in my view.
Before we continue with the video, let me tell you about a way that you can protect your data privacy, a very important topic. Data breaches are becoming more frequent, and it's getting harder to control who has access to your personal information. Just last month, a data broker breach exposed 2.2 terabytes of personal data from 1/3 of the US population. That is why Delete Me, today's sponsor, is more important than ever. It helps you remove your personal information, like your name, address, phone number, and more, from data broker websites that buy, sell, and trade your data. The process is simple. Simply submit your information, and within 7 days, you'll receive a report showing exactly where your data was found and removed. Delete Me continues to monitor and remove your data all year long. Get 20% off of all US plans today by heading over to the link in the description down below, or simply scan the QR code here on the screen to get started. Use my promo code DavidLynn at checkout. Join thousands of people who trust Delete Me to protect their online privacy and take control of your data today. I know we've talked about the quantity theory of money and how that impacts inflation, but what about the wage side? Is inflation partly contributed or driven by, should I say, wage cost pressures as well?
No, those are all symptoms of things that have happened to the money supply a year or 2 years, 3 years ago.
But in the labor market, the theory goes that the labor market is tight and employers have to pay people a little bit more. Wouldn't that mean that they have to also raise prices?
Well, but why? You have to look at what's been going on with the money supply prior to it. The money supply has come down, and that'll be taking the pressure off of the labor market, not the other way around. And again, by the way, if you do look under the hood at the labor market and think it's deteriorating and getting soft, in general, in aggregate, they're probably taking pressure off of the labor market, not increasing.
All right.
We see increases in wages with a lag after we've had a big jump up in the money supply. We've actually had a big contraction in the money supply, and with a lag, that tends to take pressure off.
Well, we left it at a cliffhanger. Let's take a look at Trump's response to Kudlow's question that you answered.
There's something unbalanced about all these numbers and where the country's going.
Well, especially so since, as you see, and I guess you probably read one of the numbers where the illegal migrants that are coming into the country are getting the jobs. They're getting most of the jobs. And the citizens aren't getting the jobs. And the other thing that you don't know what to believe anymore, because 818,000 jobs 2 months ago was a fraud. They put in 818,000 extra jobs, and it got wiped out. They said they made a mistake. That wasn't a mistake. That was done on purpose. And it was supposed to come out, that number, the wipeout was supposed to be after the election. But you had a whistleblower that came out and announced that they defrauded the country. So you say, like, how does that happen? I've never heard of a thing. I've heard of they were off by 10,000, 15,000. They were off by 818,000 jobs. So when is that going to come out?
Yeah, well, it's probably be revised down.
All right, I'll let you respond to that. He talked about he said a lot of things there.
Yeah, former President Trump did say a lot of things. But you got to be very careful with this. The category of jobs being increased were foreign born. Now, foreign born individuals aren't necessarily illegal. He defined them as illegal.
Yeah. Okay. Yeah. I know that was.
So you have to be. If you look precisely at what Trump says, he uses a lot of adjectives that aren't accurate. But the general drift of what he had to say is correct. I mean that is what the report says. But he tends to give it a, shall we say, a little bit of an exaggerated flavor. He spins the thing the way he wants it spun. So, and a good example is the category for increased jobs was foreign-born individuals, and he labels those not as foreign-born. he relabels that category as illegals.
Okay,
What
so
what if you were in the United States running this podcast thing?
yeah,
Okay, you're born in Canada. I think. I've never asked you.
no,
I think.
I was born in Taiwan, but I grew up in
Yeah, yeah.
Canada.
Oh, okay.
So
So that would be, you would still qualify as foreign born. So
correct.
if you were in the United States legally working, had a green card and all that stuff,
Mm-hmm.
David Lynn would be in the foreign born category. Whatever you were doing, if you didn't have a job one month and then the next month you found a job, you would be in the foreign born category.
This
but
is an interesting.
you wouldn't be illegal.
This is an interesting topic. The contribution to the economy by illegal workers. So suppose I move to the States. I don't have a visa. I don't have a green card. I'm not legally allowed to be there. But suppose I run a successful media business. I employ a lot of people. Does it really matter for the economy if I have my papers in order? I'm not condoning illegal immigration. I'm just asking in theory, the impact to the economy.
In terms of the data, it does matter, because if you were illegal,
Mm-hmm.
I don't think you would be counted as a foreign. You wouldn't be counted.
If the country were to cut down or really buckle down on immigration, illegal and or otherwise, would that have an adverse effect on economic growth or not?
Well, it depends. Number one, it would depend on the sector of the economy that you're talking about. So let's say look at the dairy industry in the United States. For example, there are a lot of foreign born, and I think probably, my guess is probably a lot of illegals too in the dairy industry. So if for some reason you cut that out, what does it mean? Or you send them home. You send all the illegals in the dairy industry home. What does that mean? You have a labor shortage, and the wages for those people in the dairy industry go up, and you have labor problems. And ultimately, if that's the case, by the way, what you're going to find is that there'll be a lot of entrepreneurial activity and a lot of innovation in the dairy industry, and a lot more robots replacing human workers, laborers, and things like that. So it's all very complicated, and you have to be very careful with what one is saying and how you interpret what one is saying. But I think that's why I think you have to just look at each sector. You have different effects in different sectors on the labor market due to emigration or immigration. One of the two, either going in or coming out, affects different parts of the labor market in dramatically different ways.
So here's the number that people were commenting or concerned about. Going back to this table here, 254,000 jobs added last month, 21,000 from goods producing, scrolling all the way down, 31,000 from government jobs. So if you go to the BLS report, employment in government continued its upward trend. 31,000. Government had an average monthly gain of 45,000 jobs over the past 12 months. Employment in social assistance increased by 27,000. So if you take a look at it, government jobs grew faster than what is supposedly known as goods producing jobs. Total private jobs increased 223,000. I'll just let you comment on whether or not this actually shows deterioration in health if the government employees grow at a reasonably fast pace, contributing to the...
That indicates deterioration as far as I'm concerned, in a couple of ways. One of the big ways is that you have to ask, what are those government employees actually contributing to anything? They're actually a drag on productivity. All of this increase, people wonder why productivity isn't booming, and that's because a lot of these people have jobs, and what are they doing? They're shuffling paper around. A lot of them aren't even going to the office. One of the big problems that government jobs right now in Washington, D.C., is that government employees aren't going to the office. They stay home, and you know what they do. I don't have to tell you. You know, you got a bunch of couch potatoes getting a high pay. The government pay, by the way, is higher. This is another reason why you have more people going into government. You don't have to do much, and you actually get paid in the same kind of job activity more in the government sector than the private sector. So that's just the world upside down.
So I'm guessing you don't like a bigger government. People should be working for the private sector. That's my take from this.
Yeah, I think the optimum size of the U.S. government, I agree with Milton Friedman, it's probably around 10% of GDP, about 10%.
Oh, I don't. What is it now? Do you know?
Or can you Google it? Get us the right number.
I'll look at it.
Total government employment. Total government. G. We have consumption plus investment plus government. What's the G as a percent of GDP? Because GDP equals consumption plus investment plus government. So G is what? It's
U.S. government. I have it right here. Actually, U.S. government spending to GDP last recorded at 34.4% of GDP in 2023. I guess these numbers come out.
You know, I was going to guess, but I was afraid to. I usually am. I was going to guess 35. I was pretty close. My guess.
Okay, that was actually very close. But look at this trend, Professor. It's been declining. So I don't know.
Just for the viewers, so we don't get out in the weeds too far for them.
Yeah.
The number is 35% now. I think it should be optimally about 10%. So that's a huge reduction, and that would be a huge benefit to the U.S. economy in terms of productivity and growth. The growth rate would go up, and the productivity would go up. Now, if you look at it, for context, by the way, it's about 56% in France. It's 35% in the United States. It's about 56% in France. So you think things are bad here? Go to France.
Okay, well, they have higher government spending. Do they have higher productivity? Do they have higher growth? Do they have higher standards of living overall?
Their growth rate this year is estimated at 0.7%. Less than 1% is the rate of growth. They're in the tank. They're in the tank. They got huge fiscal problems. They've just been downgraded by Moody's. You know, even nothing but trouble.
We have to get back to the markets now. Let's stimulus from China. Okay. China unveils the most aggressive stimulus since pandemic. China's central bank on Tuesday unveiled stimulus that is needed to pull the economy out of deflation, says this article. The broader than expected package offers more funding and interest rate cuts. They cut the central bank policy rate. They cut mortgage rates, among other things. It's been hailed as the most significant PBOC stimulus package since the early days of the pandemic. Broad stimulus measures across the board. The property crisis, that we can talk about that. I don't know if this is going to help that, but basically, as you're aware, the property market crashed, and 70% of household savings are parked in real estate in China. So that's significant that any sort of upturn in the property markets may help with overall wealth generation. Professor Hanke, what is going to happen to the other central banks? Is China now going to, I guess, import stimulative attitudes in the Western banks as well?
Well, the stimulus package did turn around confidence, and the markets zoomed. I mean, unprecedented rally in the markets. The markets had been going down, down, down in China. They just shot straight up. So there was a positive confidence shock, but it won't last because everything that you went through there nothing gets into what's going on with the money supply. The money supply is growing at about 6% per year in China, and Hanke's golden growth rate, a rate consistent with hitting the inflation target at 3% in China, is a little over 11%, almost 12%. So the money supply is growing way too slowly, and nothing in this package did anything to change the rate of growth in the money supply. So it won't be sustainable unless they goose the money supply. The money supply is growing at 6%. They've got to get it up to around 11 or 12% so that they can stabilize growth and hit their inflation target of 3%. Right now, inflation is essentially non-existent in China. It's 0.6% per year. So short term, it was kind of a flash in the pan, a huge confidence shock. There's no question about it. The stock market zoomed. Will this be sustainable? And to answer that question, you've got to look at what's going on with the money supply. And nothing they did has changed the trajectory of the money supply, which is very anemic. So it's a flash in the pan. It's not going to last.
In theory, could China help the U.S. with staving off a recession if their stimulus package is significant enough?
No.
Fair enough.
I mean, recessions are not global; they're local. If China increased the money supply and aggregate demand got up to a potential level where it should be in China, you'd see the big effect would be in the commodity markets. The commodity markets, because China is a huge importer of commodities. So China is basically the elephant in the room when it comes to the commodity markets. If China is doing well and growing rapidly, the commodity markets are strong. If China is not growing rapidly, then the commodity markets really they're facing a headwind.
Okay, turning now to today's market movements. The Dow dropped about 300 points or 0.8%. The S&P is also down. Oil is up 4 basis points. The benchmark 10-year yield is also up. So big declines in the stock markets and big increases in oil. Actually, oil's up only 3% now. It was up 4%. Anyway, so oil was up on the back of geopolitical tensions. Let's talk about oil. I think I know what you were going to say, but I'll ask you anyway because this is my job. What happens if oil goes up to, let's say, $100? Will inflation come back?
Well, no. Inflation is caused by changes in the money supply, and the great example of that is in 1970s in Japan. What happened? There was an oil embargo in 1973. The Bank of Japan and oil prices shot up with the embargo, of course, in 1973. And to accommodate that, the Bank of Japan loosened and goosed the money supply. And of course, you had inflation. In 79, there was another oil shock. Prices of oil went up. The Bank of Japan says, oh, we're not going to play ball with the thing this time around. We're not going to goose the money supply. And as a result, oil prices went up in 79, but inflation didn't go up in Japan because the money supply didn't go up. So inflation is always and everywhere a monetary phenomenon. Now, the big thing with the oil market and the geopolitical aspect is that Israel is playing a dangerous game, and they're on the escalation ladder. And they're talking even with the United States, and they've got one of the top U.S. generals is actually in Israel today as we speak, October 7th, and they're talking about striking directly Iran. with an attack against oil and oil fields, oil refineries. Now, if they did that, if you look at Iran produces 2% of the world's oil. So if the 2% was knocked out, and most of that's sold to China, if that was knocked out, it would have an effect on the oil market, and that's what we're seeing right now.
Yeah,
because oil's trading at about $77 a barrel. Last week it was about 70, so it's gone up quite a bit as the saber rattling has increased. But the key thing is the Strait of Hormuz. Iran could shut that down, and that accounts for about 20% of the world's oil production goes through the strait, because you got Saudi oil, Kuwait oil, UAE oil. It all goes through the strait. If that was shut down, you would have 20% of oil production shut down. That would be catastrophic. I mean, you would see the oil going through the roof. So that's what's going on in the Middle East, a very, very dangerous game where the U.S. is unable to shut the Israeli war machine down. They're actually financing the war machine, and the bombs and things that they're throwing into Lebanon. Most of those are made in the good old USA. So the U.S. is playing kind of a double game here, and dangerous.
Could the U.S. just pump out more shale and then counteract any tensions in the Middle East?
No, there's no way they could counteract that much.
Okay, Iran has threatened.
Even the 2%, that if that was eliminated, it would be a big deal. If 20% was eliminated, it would be a catastrophic deal, and that's the Strait of Hormuz. So you got two things going on: oil production coming out of Iran, 2% of world's oil output. Oil coming out of the Strait of Hormuz, that's 20%. So you got two different things. I mean, the Strait of Hormuz, that's 10 times more greater than the Iranian production.
Iran has threatened to retaliate if Israel bombs Iran's oil facilities, and Iran's retaliation could come in the form of bombing or destroying other oil facilities in the Middle East that may be more friendly to the West. If that happens, analysts tell me, and on other news as well, that oil could go up as high as $200. This was months ago, actually. I've had this conversation months ago. But anyway, it's resurfacing the news now. Suppose oil spikes again. Will we have a forced recession, meaning people here spend less because...
Yeah. There's no question about it. That's basically just what I told you.
Okay, you told me that as well, yes.
Yeah.
So we have the money supply shrink. Yeah.
When I say catastrophic, I mean catastrophic. You would have a world depression if 20% of the oil was cut. If you shut the Gulf of Hormuz and there was other associated damage to oil production facilities in the Middle East, you'd really have a problem on your hands.
Could the U.S. just draw from its strategic petroleum reserve in the interim before this crisis gets resolved?
No.
That wouldn't help?
Well, it would. It'd be a drop in the bucket, as they say.
Yeah. Okay, fair enough. Professor, let's end on some election odds. So we've talked about the betting markets before. This is from Polymarket. Odds have been kind of flat in the last couple of months. Flat by flat, I mean they haven't changed much for Trump and or Harris. They've been oscillating back and forth, with Harris sometimes in the lead, Trump sometimes in the lead. It's now back to Trump now. This just seems very ephemeral. In theory, should we care about this?
Oh yeah, the one thing, there are polls that come out, and most of the polls, by the way, have Harris ahead of Trump overall, and I think they're biased, and because a lot of people, when they get a telephone call from a pollster, they actually don't have an incentive to tell the truth. They will tell the pollster what they think the pollster wants to hear. And the pollsters, many people think the pollsters want to hear Harris. They don't want to hear Trump. So I think there's a bias in the polls. If you look at the betting markets, which you have up there now, which I look at, which are objective, those are people betting with their own dollars. So they're not biased. They're betting on where they think they can win. And now I just looked at this thing about an hour ago, and Trump overall was coming in at 54.2% in poly markets, the betting market, the prediction market. Harris 45.2. If you look at the key state where Trump was campaigning over the weekend, he just jumped again. He's up to 56% probability of him winning, and Harris down at 44. So there has been over the weekend a change in that betting market picture, with Trump looking like he's picking up steam. And that's objective. It's a little bit, we look, David, at the Fed funds futures market.
Yeah.
And why do we look at that Chicago Mercantile Exchange Fed funds futures market? To look at the probability of where the Fed is going to go with its next interest rate move for the Fed funds. Now, that's one place to find the data. And that's objective. That's people with skin in the game in the Fed funds futures market. Other places you can look at chief economists at various banks, the consensus of the economists and so forth. That's like polling data. And even they have more of an incentive to tell the truth, and a chief economist at a bank than someone just getting a telephone call from a pollster, because the chief economist at the bank, if he's wrong all the time, he's probably going to get a pink slip and get fired.
It's like the CME Fed watch tool. The closer you get to the actual Fed announcement, the higher the accuracy of the Fed watch tool. A couple of days before, in my recollection, it's never missed from what I've observed. Maybe I'm wrong. At what date would this be certainly accurate? A week before the election, couple days, 2 weeks.
Yeah, obviously, the closer you come to the event, the more accuracy will be embedded in the betting market. The further away, everything is, a lot can happen between now and 30 days from now when the election occurs. So the thing's going all over the place, but the best thing to do, look at the poly markets, because you get real-time data. You get minute-by-minute changes. In other words, when you look at these speaking events, like, did Trump have any effect when he went up to Butler, Pennsylvania over the weekend? Yes. You can see it in the betting markets. The betting market in Pennsylvania now has Trump at 56% chance of winning and Harris down at 44. That's a big improvement from where Trump was before he gave that address in Butler this weekend.
Well, we'll see how these odds shift over the coming weeks. It would be an interesting case study if the odds favored one candidate by election night and it turns out wrong. That would be an interesting case study as to why the markets get something wrong. I know it's rare, but it happened in France, right? You pointed this out to me. The betting markets for the French election this summer were essentially wrong. Was that just not a big enough market there for the odds?
I haven't gone back and done kind of an ex post evaluation. As you say, generally, they're the most reliable thing we have. Whether they're always right, even close to the day of the election, I don't know, because, by the way, they're betting. If you look at poly markets, David, they're betting on hundreds of different things.
Right.
So all I can say is those are objective data. not subjective data. Polling data are subjective. Betting market data are objective because it's like a magnet sucking in all the subjective information, all the bettors coming in all together in a market, and we're basically getting a market price.
By the way, Kamala Harris did release her economic proposal or plan. We're not going to go over it today, but we will. I would like to talk about this next time I'm on the show with you, Professor. This is the plan. We're going to compare closer to the election data. I'd like us to compare Kamala's plan for the economy against Trump's, and then we can speculate as to how the economy may change under different regimes. The plan is called A New Way Forward for the Middle Class, and a lot of it has to do with tax breaks for the working class, stimulus measures for small businesses, stimulus measures for housing. She wants to build more units. She wants to give $25,000 for first-time buyers in the form of grants and tax credits. We'll talk about that next time. So lots to go over here. It's 81 pages, but I'll get some highlights ready for us to discuss.
It's 81 pages of how the government is going to fill your pockets with money.
Maybe that's a good thing. Maybe it isn't. I'll let you answer that next time.
The answer to that is no. It's a
okay. All right.
Anytime Uncle Sam promises me something, I'm very suspicious.
Wait a minute, you don't want more money?
Because the tendency is they might put something in one pocket, but they take more out of the other pocket than they put in the pocket that's being filled.
So you just have to make sure you're on the right side of which pocket you are.
Oh yeah, you've got to be in there with the right lobbyist.
Well, anyway, we'll talk about what economists and other banks have been projecting her plan may do for the economy, stimulus measures, what kind of growth numbers we can expect, so on and so forth. Great talk today, Professor. By the way, if you're watching this right now and you'd like to submit questions to us, please feel free. I'll put the link to Professor Hanke's Twitter or X handle down below, as well as his email in the description. So please write to us next time. Let us know topics you like to hear. Thank you very much, Professor Hanke. We'll speak soon.
Well, thank you, David. Great to be with you as usual. Have a good day.
You too. Thank you for watching. Don't forget to like and subscribe.